I'm convinced that the financial services industry has a really big role to play when it comes to creating a greener and generally more sustainable economic growth. And today I'll be talking about how the right information on financial instruments and financial products can support this and also help to address changing customer needs. But first, a few words about SIX. So SIX is a Swiss-based company, but we're active internationally. We have 4 business units. We run the Swiss stock exchange, but also the Spanish stock exchange. And we launched the first regulated digital exchange last year. We also have a securities services business that focuses on post-trading activities, clearing, settlement, and so on. And then the financial information business, and that's where I'm located. So we provide financial information to banks, asset managers, wealth management companies. We're very focused on corporate actions, but also regulatory data services. We actually provide data for more than 70 different regulations worldwide, where we support our clients in complying with those regulations. We've got more than 90 years of experience in the provision of data. And then we also have a banking services unit that focuses on payment services. So what trends do we see in the sustainable investing market? First of all, we see very much increased investor demand for ESG and sustainable investments. This started with institutional investors that went ahead, but now we really see this trend being also mirrored by retail investors. With generational change as well, more and more millennials having money to invest, they're much more focused on not only achieving a good return with their investments, but also making a positive impact. And then, of course, that then leads to growth in ESG and sustainable product offerings. The value of ESG asset has surpassed $35 trillion in 2020. Of course, you find all sorts of statistics, but that's an official one. And, you know, we also see that new issuance of sustainable funds or green, social, sustainable bonds is really rising sharply. We also see that on our database, you know, daily. The number of green or sustainable funds on our database is rising. And then we have the political and the regulatory environment that also plays into this. It all started with the UN Sustainable Development Goals and the Paris Agreement in 2016. At the same time, we had the Volkswagen scandal. And, you know, now since then, we've seen many different countries issuing regulations on this or legislation, and political pressure has really increased. And, you know, we see all this coming together, which really changes the whole environment we operate in. Here, those statistics that I mentioned before on the growth in sustainable investment assets worldwide, we see here that sustainable investments increased or more than doubled over the past 6 years. What this graph also shows is that it's not always clear what is green or what is sustainable. So here it actually looks like that, you know, in 2020 compared to 2018, the sustainable investments or sustainable assets reduced in Europe, which is not entirely correct because there was actually a reclassification. So there is more other criteria being applied. So it's not that in Europe those assets decreased and the US surpassed, but it's really a different way of measuring. And I think that nicely shows that we do need certain guidelines to explain or to let everyone know what is sustainable, what is green. And that's exactly what the EU, for example, is working on. But what this graph should really show is, the trend and the huge growth rates that we generally see in this. And this trend and that direction is continuing. So to come to those regulations, the EU is really going ahead with regulations on this, but closely followed by other jurisdictions or regions worldwide. And the EU came up with this EU Action Plan on Sustainable Finance, which again is based on the Paris Agreement and the UN Agenda for Sustainable Development. The EU Action Plan has three main goals. First of all, it wants to reorient capital to more sustainable investments, to more sustainable companies and projects. And there I also believe that the financial services industry, again, really has a role to play in helping to channel that money to those firms and projects, and therefore, again, help to make that transition. The second big goal is to manage financial risks that are stemming from climate change and other environmental and social issues. I used to be a risk manager in my previous life. ESG risk was never a topic. Well, governance was a topic to some degrees, but the environmental and social aspects were not a topic a few years back. Now they are one and are clearly a risk that needs to be considered when making investments. And then the third big goal is to foster transparency and long-termism in financial and economic activity. And all these has led to a flood of regulatory measures and initiatives. And I'm primarily focused on two of those, which is the EU Taxonomy and the SFDR regulation, the Sustainable Finance Disclosure Regulation. And this impacts the whole financial services industry, not only in Europe, but actually beyond. So on the right-hand side, you see all the financial service providers that fall under these regulations. So it is investment advisors, asset managers, fund managers, even the insurance sector. And geography-wise, it's not only financial institutions headquartered somewhere in the EU, but it's everyone with some business relations in the EU, be it a client based in the EU, or being it managing an EU-based fund, for example, or also selling a product into the EU. So all these financial institutions are affected and need to comply with those regulations. And then we have the corporate side, because of course the financial institutions need a lot of information from the corporates they're investing in to make those investment decisions and then being able to make their disclosures that they need to make. The corporations don't fall under SFDR, so there is a bit of a challenge there. So we have different regulations applying to the corporate sector. So we have the NFRD, the Non-Financial Reporting Directive, which requires some taxonomy disclosures. And then we have a regulation that's proposed, but not there yet. And that's the CSRD, the Corporate Sustainability Reporting Directive. A bit more on this slide on this. So again, on the right-hand side, you can see the financial institutions sector, which I mentioned. They fall under SFDR, Sustainable Finance Disclosure Regulation, also the EU Taxonomy. And there it's grouped into different types of financial service providers. So we have the manufacturers of financial products, so typically the fund managers that fall under the regulations. And then we also have the investment firms that are defined as offering portfolio management services. So all these have to comply with SFDR and taxonomy. What's not on this slide is that ESG also flows into the MiFID regulations. It also flows into UCITS, It also flows into AIFMD and also the IDD, the Insurance Distribution Directive. So all these regulations now have ESG components, and it all fits together one way or another, or doesn't always completely fit, and that's exactly the challenge that we're dealing with at the moment. And then, as I mentioned before, on the corporate side, we have different regulations again, and they're not always fully aligned, and that's the big challenge. So NFRD is in place, and since the beginning of this year, corporates also have to make some taxonomy disclosures. Not all yet, the bulk will follow in the beginning of next year, but there are some taxonomy disclosures already there. CSRD is only proposed at the moment, so if all comes as planned, this will come into effect in 2023, with the first disclosures coming in 2024. So the challenge there is that we're missing corporate information, so the investee company information that all these asset managers and investment firms need to then make their sustainable investment decisions and make the disclosures to their clients that they're supposed to make. So how does this all come together? So at SIX, we see ourselves as a kind of a hub to bring that corporate information together with the information from the financial services industry. And there are different types of data flows. So there is the investee company data, so the corporate data, and there is the data flowing from the manufacturers of financial products to the distributors of those financial products or the investment firms. And that also means we have kind of two different types of data. We have investee company data, again, corporate data, and we have the manufacturer data. And at SIX, we decided to work with established data providers, ESG data providers, such as Sustainalytics, MSCI or Moody's, for example, who have been collecting company information for many years. They can also fill gaps, because there are still a lot of gaps, as I mentioned. So they can fill gaps for certain companies if they don't disclose on certain aspects. But they can also fill gaps in terms of regions, because, of course, it's the EU-based companies, corporates, that will need to report, but you need similar and comparable information for your investments that you might have in the US or Asia as well. So that's why we work with those established providers to then offer data sets to address SFDR requirement, taxonomy requirements, but also things like ESG risk ratings and scores and controversies information that's also often used by our clients to make investment decisions. And then in addition to that, we have this manufacturer data, which we source directly from the asset managers. We have connections to several hundred asset managers where we have been collecting data. I mentioned before, we cover more than 70 regulations, so this is our core business, collecting data from many different providers, such as asset managers or fund managers. And that data is also collected, and then we give that to the distributors of those funds, for example, or also structured products going forward. And that's kind of how it comes together. So you have the company information to make your decisions for your equity and bond investments, and you have the manufacturer information to make your decisions on the fund and structured product investments. And this we distribute to institutional asset managers, wealth management firms, or also asset owners, because, as I mentioned before, insurance is also affected by these. A few words more on the manufacturer data. You may have heard of Findatex. Findatex issues templates to help with that data flow from the manufacturers of financial products to the distributors. So we source a lot of data according to those templates, We also source directly out of prospectuses and other means, but those templates are a very important source of information. And there, Findatex, about a year ago, March last year, introduced some ESG information as part of the EMT template, the European MiFID template. And then we immediately started to also deliver that type of information to our clients. Later, last year, Findatex then decided to come out with an EET, a European ESG template. That's now just been finalized on the 14th of March, so we now have the final version of that EET. It contains more than 600 data fields relating to ESG, so you can imagine very detailed information. And this will come into force from June 2022. So that means that supports the data gathering from funds and structured products on all these ESG data points. And it addresses these needs from different regulations such as SFDR, Taxonomy, but also MiFID II and the IDD, the Insurance Distribution Directive. What Findatex also decided is that all the ESG information that had been in the previous EMT template will come out. So with EMT version 4, that comes in August, we won't have any ESG information anymore in the EMT template. That will all be based on the EET template. And that's also how we structure our data offerings. So in June, this EET will become applicable. That means the manufacturers of funds and structured products will start to disclose certain ESG information. Actually, it's about 50 to 60 fields that are mandatory or conditional starting from June. Then that will be EET phase 1. Then we'll have a phase 2, and that will start next year when the manufacturers will start to disclose on the other 600 or the other 550 fields. Of course, not every fund will have information on all those fields because they have different focuses as well. But you know those templates will start to get filled in the first half of next year. At SIX, we start delivering this information to our clients from the 12th of July onwards. So we're very actively working on this to be ready by the 12th of July. And as I said, you know, it was only finalized less than 2 weeks ago. So everybody is very busy with all those implementations. And this information will go to distributors in a first instance because under MiFID II, and under IDD, you have ESG requirements from August 22. So that information will be ready to address those MiFID II requirements from August. And then, as I mentioned, the big bulk of information coming next year, which will then address the SFDR level 2 regulation and certain taxonomy information requirements. So why do clients come to us, basically? So, of course, we want to support our clients in fulfilling their regulatory compliance, regulatory compliance, basically. And of course, because we aggregate data from different providers, so the ESG data providers, the specialist data providers, as well as going out to all these manufacturers of financial products, we provide aggregated information out of one hand, basically. The data is normalized. It becomes comparable as well by putting it all in the same data structure, linked to other reference data or corporate actions pricing data. And, you know, it comes via the delivery capabilities that our clients know and often have integrated in their systems. So, of course, that makes the whole data sourcing much simpler than going out and trying to connect to different providers who deliver in different formats, sometimes don't use the standard identifiers. Another thing we also do is actually map the company level information to those equities and bonds. So it's easier for our clients to consume that data. They look at their portfolios and say, for which equities and bonds they need the information, rather than having to map it to the companies in a cumbersome way. So that really supports our clients, and of course lets them focus on what they want to focus on, which is their client relationships. So, to kind of come back to the beginning. So with the growing customer demand, the need and the requirement for more ESG and sustainable and green investment from end customers, at the same time, we see also at firms, of course, there is a bigger willingness and interest in sustainable and ESG investing. And then in addition, we have those regulations and policies that are coming and influence the financial institutions sector, but also the corporates. So that means we will have more data available to make decisions, and it is becoming clearer what is actually green or what is sustainable and how do I measure it, and also address customers. Some customers might be interested in climate change, for example. Others might be interested in biodiversities, and the third customer might be interested in gender diversity, for example. So you do have very detailed data available to then also being able to make a decision and to fulfill those customers' needs and actually have the relevant information to tell the customer exactly what a certain investment is achieving or how it is performing on ESG criteria. So ESG data is becoming more important. There is more of it. There is more detail available. And of course, it becomes much better comparable. And that again helps, of course, the financial institutions to make more sustainable investment decisions, to issue sustainable investment products, be they funds or portfolio mandates. And of course, that can also help all the financial institutions to contribute to the net zero targets that are out there and support other environmental or social goals. At the same time, it addresses changing customer expectations. And, this, in the end, has a positive impact on the bottom line of the business. So, thanks a lot for your attention. I'm happy to take any questions.
Thank you very much, Janine. Yes, questions? I have one otherwise. We normally, and the focus, I think, in many aspects is on the E in this ESG. But what is your view on it? Is it now becoming also more focused on the S and the G?
I think so, yes, definitely. I mean, it all started with the E, and especially climate. That's really the focus at the moment. I mean, with all the goals and so on, and all the countries, there are almost 200 countries that subscribe to the UN goals. So, everybody has to do something. But we also see within the E, we see that it will move to biodiversity and other topics. And yes, also social topics more and more being addressed. They're harder to measure, though, because I think that's also why there has been a lot of focus on climate, because, greenhouse gas emissions is not easy to measure, especially if you come to Scope 3 and Scope 2 as well, to a certain extent. But, it's kind of measurable, whereas a lot of the social factors are hard to measure.
So the data that you collect for the S and the D, maybe then that is a more sort of the data collection without sort of being able to identify sort of goals or objectives or measure it. It's more of a sort of someone else to have to analyze it. Or?
Yeah, I mean there are still guidelines. How, and now especially with those regulations, there are guidelines, you know, what you have to measure and what they should say. But of course, they're less quantitative. They're more qualitative than some of the environmental data points.
So are there, for example, quantitative, where if you look at a board structure or an executive management of a company where you actually see how is the diversity, both for out of sexes or also diversity in gender, what type of, so that can be, the criteria are there? Or
there are some measures, exactly. I mean, you can count how many women and how many men are on a board, but that doesn't always tell you that much, right? So it's very high level, I would say. You know, the quality of the board, it's hard to measure. So you can count, you know, how many men and women, but the quality, it's then still hard to measure. So very high level, I would say, what you can measure on social.
Thank you. Ayaz here from Microsoft. I actually like the point you made there about diversity inclusion. And I think in terms of this conference, it's sometimes built in, but it's not raised to this level. How do you drive diversity inclusion at this level? As you said, a board, you can measure diversity, you can measure inclusion, but it's not happening. And if it doesn't become one of these points, no one will do it. So I think definitely the S point is important. I'm working a lot with diversity and inclusion and measuring. We're doing a lot of measurements in Sweden. We try that around ethnical lines, but also around accessibility and all. But I think at this level, there's more points, more things to do. Mm-hmm. I know there's a comment.
Yeah, and I think also this is all about transparency. In the end, that's important. You know, if companies have to disclose and have to be transparent, then, you know, it's up to the users of the information to make with it what they want. But, you know, at least the transparency is there and allows you to make a decision on, you know, aspects as diversity or whatever it may be.
Thank you for that. We have it behind you, Danielle.
Yeah, hi. This is very interesting, so thank you. One question, how will this data be consumed by, like, digestible, let's say, by investors and users? Will it be like a standardized report, or will it be like up to each fund distributor to like provide a different user experience?
So so in the end it is up to, let's say, the distributors. So if we talk about wealth managers, for example, the regulation does not say exactly how they have to make their sustainable investment decisions. That's up to the distributor in the end. Also, you know, the fund managers, you know, it's up to them to decide how, you know, if they have a sustainable fund, you know, how they do that. But they have to be transparent about what they did, you know, and disclose on different data points. That's really the essence. As I said, transparency is kind of the essence of the regulation. So it doesn't tell you exactly how you want to do it. So some take quite a simple approach and say, hey, I'm mainly interested in ESG ratings and scores to make a decision. And others, you know, they really want to look into the details. And, you know, the details will be there going forward to actually use it if required. But we also see with our clients, there is a wide range of sophistication and you know, state basically how advanced they are in this topic. I mean, some started, you know, several years ago, and they really want very detailed information. They're also looking at alternative data and so on. And others, they're starting now, you know, also because the regulations are coming and they have customers asking and they realize, I need to do something. But I think this can be also, even though it's a regulatory topic, it can be much more than just ticking a box and can actually be, you know, offering good sustainable products to clients and addressing those client needs.
One of my clients have asked our company to fill out a form provided by a company called EcoVadis, which is just purely about sustainability. And I think it's also very specified for each company to fill that out. Are you getting data from companies like that as well into this?
So that type of data would come via the ESG data providers we work with.
Okay.
So we don't collect from corporates directly, right? That's why we use those established providers that have been doing this for a long time, and they source data directly from company reports, but they also use other sources to do so. So where we do the direct sourcing is really kind of based on our experience with all the fund managers and issuers of structured products.